Sure.
Well, everyone, welcome to a Chat with Traders community presentation. This is your host, Ian Cox, and today we're welcoming back Andres Granger from South Korea. We had him on the regular podcast, episode 263. Welcome back, Andres.
Hello. That's everything. That all in one. Perfect.
Yeah.
My whole life story as well. Um, Hi. Well, thanks for anyone who's coming in today, and then any of the other people that are going to be viewing later. Today, I'd like to go over some execution as a topic in general, and strategies, timeframes, kind of strategies that you'd run if you are trying to execute and just you don't care that much. It's just get the trade on versus something where the execution really does matter. But again, what I'm going over today is really not at all crypto based. But in the end, trading and execution, whether it's futures, options, stock market, whatever it might be, so much of it's really just based off of order book principles. A big part of what I did really want to cover today was the difference in risk versus edge. And, I mean, you can see this online all the time, is even I've written here, the make $100 in a day. I mean, that's just like everything but so much of it is based off of the idea that, okay, this strategy has an edge, or there's a probability that this strategy will work out. And the majority of the time, all it is something that's actually taking on risk, and that's what you're getting paid for. And if it works out, you make money. If it doesn't, you don't. And really what's happening there is the majority of time that traders do make money from trades like that, they're making money from their own risk management. And it's really a 50-50 shot, right? That it's going to go in your favor or not. But what you do from there, obviously the management side of it is most important. Part of this as well is understanding the kind of game that you're playing in these markets. One of the most important concepts that I think most don't really understand when they're getting into trading is that markets are random. They're very, very random in so many ways. And it's not like something like a card game where maybe if you play like 21, there can be an edge. You can create an edge in that game because the probabilities, the outcomes, there's only a certain amount between every hand that you're playing. If you get dealt a certain hand, you know that those cards are missing from the deck. There's this many outcomes that are left on the table. Trading in markets, it's time frames. There's many other traders doing many other things in the same exact market. Also, it's not something like the typical fighting game I think that we all grew up with when we were kids. And on this idea concept here of trading and it not being a fighting game or a sport, those games are a beginning and an end. Trading is different because it's a constant game that you come in, you participate in each day, you leave, and you come back to it the next day. So the idea that you always want to be able to come back. What I would say it's a bit more like, and a somewhat similar concept to how it's a little bit more like a RPG game where you may search around a forest and fight little battles or collect little coins or tokens, points, or whatever it is, and you build up your character over time. You're doing it one day at a time, one trade at a time, and every little bit helps you in the long run. But again, you always want to be working towards a positive expectancy, not taking large losses that will take you out of the game the next day and where you can't come back. On that topic, the fact is there are very few actual edges in this very random market. There are very few things that actually provide a complete edge for you. It's good to just understand and know that what you're trading is very random, very random. So do I try to go after complete edge and find an edge, or do I really just decide to execute something where I know things may be random, but what I do while I'm in the trade, I'm going to manage it and take care of what I need to do to keep myself alive and move on to the next trade. I've brought up just a very random type of trade, and this is just as an example. Obviously, you can take a look at this and say, oh, this is not a trade that I would be taking. This goes against my own rules set. that's completely fine. Again, just as an example in this one right here this time. The idea in this one would be, okay, you want to take a break of a range kind of trade, or a breakout. If we're to look at this and you say, okay, I want to be in the trade, it's 59.08, so we're going to call that 08s. But if we look at the order book, we can see 08 now pulls down, maybe it's 08, 07. This is like a second later when I screenshotted it through my actual DOM. But, okay, so it's 07. Hit market and, we're entered into the trade. But if we actually just look at the order book and what's happening here, we could see that, oh, maybe that's not what I would really want to be trading right now, or maybe that's not the way I want to enter or execute this trade. Well, if I do hit market, I can have 07s, and there's 4,400 on the offer. Okay. And on the bid side, okay, it's only 2,500, but that's at 04s. So I don't have to take 07s with a market order. If I really want to be aggressive, I could probably even offer, put a bid in at 06s. And what kind of a fill would that get me? Well, it would get me a tiny bit better. Instead of going in at 07s, I can go in at 06 as well. Obviously, if I can do that, maybe I could try 05s. And if I feel that maybe the bid at 04s, this 2,500, that's thin enough to where the average size, I might even get a fill there, especially if I'm trading in smaller size. So would that be better for me? Possibly even go farther back in the book? Any choice you have, you could go with whatever. Obviously, though, the suboptimal choice would really be to hit into 07s. You would probably, more than likely, get your fill at another price going lower than that, just for this trade. So we don't know what's going to happen. Things are random. Things could change. But again, you can give it a try and see if you can get better execution. So what does happen here, and again, I literally pulled this as random as I could. It wouldn't matter either way, whether it be a winning trade or not. Market moves down, so you could have gotten filled at 06s, 05s, 04s, obviously, and all the way down to 01s. If we did that as a trade and we got filled at 07s, way up here, the trade would now be against us by quite a bit. What did happen with the trade was it doesn't work out. It goes back to a range, whatever you might want to call it. But if we're able to go back and say originally, okay, instead of just going off the context of what's happening on a chart, one moving indicator going over, crossing over a line that tells us to execute our trade, and using some very basic order flow concepts, we maybe would have put our trade a little bit farther back. And not saying that just using market orders isn't the right thing to do, but by being able to read the order book and know what's going on, where you should be placing orders, how you should be working around the order book, depending on what speed, helps you to get a better fill. So the information is a little bit less random as what you could see through a chart. We kind of don't really know why something moves one way or another just because of a chart, and basing it directly off that, always saying there's a support resistance or some patterns that are going to be persistent. I think most studies overall have shown, and most quantitative traders too, they laugh at any technical analysis because they're quants and they can test things over time and see that no, it just falls apart. It goes to 50-50. That's what your average is. So if you're going to start this way of trading and start to try to improve your own execution, one great thing to look at is your MAE, okay, your max adverse excursion. So as we can see, what happens here, a bid is put out. The little yellow line, well, the yellow line are bids, purple lines are offers, and the triangles are fills. And market goes through us by several ticks and then comes back. So in the end, okay, it's a winning trade, but really, how much did I risk being in that trade versus how much I made? This is obviously not great for us. So we also want to look at our max favorable excursion for all the trades that we're doing and what those averages are. That can help us to see, okay, we're actually getting better, more favorable trades than we are getting trades that are constantly showing, oh, we're holding losers, we're holding losers. In the end, that'll come back and really bite you. It's definitely a hard thing to do, to make sure that your favorable excursion, your MFE, is always higher than your MAE. It's a very hard thing to do, but it's a great way to practice and a great metric to be looking at. Also, by focusing on the right things, it gives us an opportunity to say, hey, I was just entered in a trade, as we can see in this one. I was entered in a trade. It's not working for me. Something is off. There's factors that are currently going to the market, and there's a very big likelihood that this trade's going to get even worse. So we're able to cut trades a little bit faster. So sometimes by doing this kind of a thing, you can actually literally pick market tops and market bottoms. And that mostly is in the short term. Having good execution means you can pick your spots, get into trades, execute and be out of them, and make more. It's good to have examples of, okay, trades can move against you as well. There's a lot that goes into it, but you pick it up over time, you get better at it, and it's a skill. It's a skill to build. This is kind of what a little trading session might look like. And this is what I was mentioning just before when I was saying I took a position trade. Again, I really don't trade positions. I know and I feel that there's very little edge to be had. You're taking on risk and you're getting paid for it, which is absolutely fine. And if you manage out of that, that's great. But I come from a background of just, you're getting into trades and then you're exiting them and you're taking what you can from the market, or you're working a spread. But here I tried to take a short trade, and here I was completely wrong. In this, I decided I'm going to go with a scaling method of entering a little bit more depending on where things are at. I'm going to cut this trade really quickly if it moves against me, but I'm going to try to work a good average price. My original entry was at 906. I have 906 up here, and if you look down at the chart, so I'm calling 294096. So right about here was my original first entry. And from the little dots and all the little colorful colors, sorry, it looks like a crazy little rainbow in a way. After reviewing my average fills and overall for the trade, and yeah, being 408 of them, overall average price at 15.7. So up near here-ish, and 12.09. And that's because I'm working in and out of the position constantly as the position's going. I'm not just adding more to it, adding more. That's why there's all the yellows to go along with the purples. Yeah.
So question, in here, are you kind of cherry picking kind of the optimal time to or optimal position to get your bids in and your sell orders, depending on what the order book is doing at that time?
Yeah. Basically, now what it really would look like is something like this. I want to sell, so I put out a sell order or a series of sell orders because I feel like I might not get this off. Maybe I'll get a few different orders off, or I might be aggressive with it, depending on what's happening in the order book. I get filled wherever, but the market moves through me. But there's some little bits of information that say, you know what? The market is also about to print and have the tape basically print down through this. I'm going to buy back these orders and then resell again. So maybe I'm buying back some of them at a bit of a loss, but then I'm selling even higher again. So now my average sell order goes up. My buy order may be a scratch, maybe a profit, but I'm constantly working the book up and down.
Are these pre-programmed in to your bots, or are you manually
this is manual.
this?
This is manual, all just
manual.
Yeah.
Wow.
Yeah. So again, but my average manual trades, I'll typically do anywhere from 60 to 100 in an hour. and I'll take little breaks. As you can see in this little chart here, there's a section where I wasn't taking any trades. I got on my position size. I said, hey, it's a directional trade. I'm just going to let this thing work for me. And then it kept chopping around, and I got sick of waiting for it. So I'm like, you know what? I can work better prices again. You can see I start going for it again. And the market again picks up. You can see that some fills happened even lower because, again, very low liquidity. You can see I can get a fill at this other price. Again,
so does the low liquidity actually work in your favor?
Absolutely. Absolutely. In terms of, okay, this market, it's terrible, you get slippage, but actually as a professionals, we look at markets, or we look for actually retail to complain about slippage online, and then we look at those markets to trade in. So low liquidity in certain markets is great for us. It's great for a market maker, especially for the fact that if there's low liquidity in something, that means there's not other market makers to make that market, and you're going to be one of the first, and that means you're going to take most of the profits. So I remember this recently, that like Binance, they started a new stable coin, and they connected that to Bitcoin. And as soon as they did that, it took about other market makers a month to come online. And for that 1 month, profits per day were just great. But that's all because of order book action, understanding how things work, and then being able to bot some things that will take advantage of that, especially. So again, the trade could have been worse. I could have gotten in this trade, and what the nightmare would be is it would have shot up away from me. Again, we watched this over a 45-minute period. I would figure the market would go somewhere in this time. The price barely changed, but I'm able to get into this short position, get out of it, actually make somewhat of a profit in it. Ideally not the profit that I wanted to make, but make a profit, but even for a trade that didn't work for me. So in professional terms, that's what we look for. We're looking for trades where we can create an edge for ourselves through execution. And on the topic of execution, I had to post this on the Twitter. I thought it was just a great thread. I love the fact how I have one like on this. People didn't really care, but it is key. It's very key. So Rentec, Renaissance Technologies, the very famous, they've produced insane returns, well over 50%, pretty much yearly for decades, without having, or nearly having, almost zero drawdown. And that's after their insane fees of something like 45%. And that's what they're producing for their clients. It's just unparalleled. But again, how do they trade? Well, everything that they do is very, very, very secretive. But the few things that they do let people know are they're acting and participating in markets in very invisible ways, as much as they can be. And even if they take a trade, and even if it is a position trade, they're doing that style of trading and doing tons of orders. I mean, Christ, 150,000 orders to 300,000 orders. But I can see how that's very true. Very true. For high-level professionals, that's the way we really try to interact with the market. Whether that be at times being a market taker or a market maker. Again, just there is a great, case study. If you have any time, definitely always look up Rentec. Very interesting stuff from that. Now, again, where would this really not matter? Honestly, where do we don't have to care about our execution being clever, sophisticated, or even good, and we just want to get the trade on. That really comes down to our time frame. And that's the biggest thing that I would say, and I would suggest for traders out there that want to get into trading or that are trading and that don't have time or management to really manage those kinds of high intensity trades, is to do something more like swing trading or just longer term trades in general. The difference there is much, much, much less edge to be had, and there's a lot more randomness to it. And then it comes down to your management of trades. You can look at the statistics, but I think it was Martin Scarelli brought this up. It's people that trade directionally, that do longer term positions, that have had a really great short-term track record, never end up having a very good long-term track record. And one of the big reasons why I got into market neutral trading in general is that the traders that really survived through long-term over time, they ended up being market neutral traders. And to really keep and hold a career in this kind of business, the goal for a lot of funds, a lot of traders. It's great if you can be a directional trader and you can make money, but as Scarelli himself said it, there's very few that end up holding that track record long term, and a lot of them can have a good run, a good set of years, and then it becomes more difficult later. I put in here news related events. That is one thing to hit on. Good point. In those cases, there might be something coming out and you just want to get the trade on. And it is very, very short term, but you know the direction you want to be in, and you just have to get on a board, right? So the other guy that I actually work with too, he used to be an FX trader for a prop firm well over 10 years ago. And one of their biggest trades were news events, and the very second news would come out, again, something like that, very short term, but you don't care about your execution. You don't care about your entry. You just want to jump that trade on right away. But again, now these days, news trading is a whole beast inside of itself. Now, where execution really does matter, it's the topics that we've been talking about so far: scalping, market making, short-term stuff. Also, spread trades, even if they are long-term. So that means like arbitrage and statistical arbitrage. The fact that, okay, you might want to be holding this spread trade for days, weeks, or even a calendar month if you're doing an equities cash and carry trade where you're buying the underlying spot market, the cash market, and you're selling a futures market that's in contango, and you're waiting for that thing to basically converge and you can take your profit. But as we can see even in this little chart right here, these markets may be separated for quite a while. But if the market moves away after your entry, then you're kind of screwed. So you have to be quick with this. So again, execution is key.